Hi, my name's Will.
And I'm Ed.
We work on the officials. We produce fair value curves at the end of Singapore and European sessions every day and provide market commentary on what's driving the market at the moment. Today, we're going to be discussing the Dubai benchmark. There's been some interesting developments there in terms of how Murban's pricing recent OSPs, as well as recent OPEC cut unwind. So we'll dive into that. So what have you been seeing recently in the window, in the spot window?
Well, in the window, the key thing that we've been looking at recently is the monthly change. So the change from April trading to the change to the May trading average physical premium, because that's important for the OSP setting mechanically. So if you
check our Dubai explainer video.
Yes,
if
our
you want,
previous video
if you
for
want
some more explainers on how the structure of the window and the Dubai benchmark. But on the screen now, we can see that the average line, this dotted line throughout April trading was around $1.64.5. And then in the May trading sessions, it dropped to $1.26.5. So what that's telling you is that the backwardation in the Dubai structure and the physical strength has come off considerably month on month. And now the Saudis use this structure as their kind of indicator for where they're going to set their OSPs, their official selling prices each month. So this gives you the ballpark figure. However, they do have an element of discretion over that exact number.
Exactly. So recently, in previous months, we've seen the Saudis actually decrease OSPs by more than the structure would imply, or hike OSPs by less than the structure would imply. So in that way, they're kind of giving a bit of a gift to the market. If we look at this table, the OSPs into Asia were cut.
The Asia OSP is kind of the important one. That's the biggest market. It's the one that people look at.
OSPs into Asia, they were cut down 20 cents for that kind of Arab light, which is kind of like your benchmark grade from Saudi. But structures implied a cut of 45 cents.
So the structure's change was 38 cents month on month.
38 cents.
So you'd expect somewhere in the region of 35, 40 according to that move. But evidently they've looked at the market and decided not to be quite so kind this month. So there are a few factors. Do you want to explain a couple of those and why perhaps they haven't cut as heavily?
So for one, I think previous generosity is maybe starting to be unwound here a little bit.
You think they're cashing in on the previous kind OSP prints?
Yeah, they could be doing that, kind of making up a little bit of lost ground there. But then the big thing has been the influx of Murban, and at the start of the month, almost all of the convergences in the Dubai spot market were Murban.
We have a chart here to show that. So the light blue bars that you can see at the beginning of the month up until about the 21st of May, even, they're all Murban convergences. So obviously in the Dubai window, the seller has the right to declare a given grade within the basket. So up to this point, all of the sellers were declaring Murban exclusively before we got to move into the Oman and Upper Zakums.
Exactly, and that's kind of the whole premise of the Dubai window, is you declare the most competitive grade. The difficulty comes when the Murban is a different grade, as we discussed last week. It's a little bit lighter, it's a little bit sweeter. We had a huge influx of Murban into the spot market, which then is deliverable into IFAD, and ADNOC set their OSPs based off of the Murban futures in IFAD. So there's a discontinuity here, because you have Murban, a relatively lighter, sweeter crude, setting the Dubai benchmark, which is then used to set OSPs for Saudi grades, but it's not reflective of those benchmark Saudi grades. So naturally, the Saudis thought, well, we should probably cut by less. If you have Murban setting the floor here and Upper Zakum and Oman trading at a premium above that, and those are more reflective of the Saudi grades, that makes sense.
The other issue with Murban is really the IFAD aspect of it, because IFAD is the exchange where you can trade Murban futures, and they have a physically delivered Murban contract. So if you're say somebody who's been in the spot market, you've been buying in the spot market, you've got a load of Murban cargoes that you don't really know what to do with. an easy way to get them off your hands is go to IFAD and sell Murban futures.
Yeah.
Hold them to expiry, deliver them to whoever's bought, and then job's done. You've got rid of your Murban, and it's a very simple way of getting it off your hands.
Yeah, exactly. And that has led to Murban futures pricing under Oman futures throughout the majority of May. The difficulty there is that ADNOC set their OSPs based off of the time spread structure in Murban futures.
Yeah.
So when you have a relaxing of the curve there, that directly impacts the amount of premium they can charge over above the benchmark for their cargoes.
Yeah. It also means that, rather unpopularly for ADNOC, they have to then set their Upper Zakum, Lulu, DAS OSPs as a delta to the Murban.
Yeah.
So normally you'd expect them to, Murban is kind of their flagship, their premier grade. So you'd expect that to price at a premium to Upper Zakum, etc. However, what you're expecting now is to see Upper Zakum at a premium to Murban, which isn't normal in terms of the general kind of the previous historic expectations.
Yeah, the pricing hierarchies flipped.
Exactly. So you'll see perhaps a bit of a disgruntlement among ADNOC for that reason.
Yeah, so there's been a lot of kind of chatter about, okay, so what can we do about this? How can we rectify the issue? A lot of people have been suggesting, why isn't there a negative quality premium on Murban? So at the moment there is a quality premium.
And by the way, if you want an explanation on what a quality premium is, how it works, look back to our North Sea data Brent explained it from a few weeks ago.
Exactly. And the positive quality premium on Murban is set at 50% of the net difference between Platts Murban M+2 and Platts Oman M+2 over the 15 business days prior to the day of publication. Quite crucially is that if that is less than 50 cents per barrel, the quality premium becomes zero, but it's bound at zero. It cannot go negative, which means if Murban falls below Upper Zakum or Oman, it will set the floor in Dubai. The negative quality premium would enable Murban to price under the benchmark, which would then lead to an appreciation in Dubai. And Murban would clear with a negative quality premium, i.e. the seller pays the buyer at delivery. Yeah,
although there are a few drawbacks with this, because you could say that this is merely a reactive response or solution to a market dynamic where we've got a lot more Murban available on the market because of high production, high export quotas for Murban. Plus the fuel oil strength that has really strengthened the Upper Zakum crude.
Exactly.
So if you're going to introduce this negative quality premium now because you don't like the fact that Murban is setting Dubai, that to me doesn't suggest that it's kind of a solution to the intrinsic problem. It's more of a reactive way of resolving this thing that you, this aspect of Dubai that you don't like.
Quality premiums are lagging. They're set as the average of 15 business days prior. So they don't react particularly quickly to market fundamentals. And we've seen in the case of Murban, a lot of supply coming out and a lot of supply blended with condensate as well, which means that it yields high naphtha content. And we all know how naphtha feedstock for petrochemicals is looking at the moment. Petrochemicals are very, very bloated. A lot of excess supply there in Asia.
China.
Exactly. So it's not unsurprising that Murban has been setting the Dubai benchmark, but recently we have seen that switch
there's
a
been
little
a significant change because every month ADNOC releases its forecast for exports from the Murban field, and it had originally on I think the 28th of May published a forecast for around 1.75 million barrels per day across the next 12 months, fairly steady. But they've since revised it early this week to have that export schedule drop off towards 1.5 million barrels per day towards the late summer, early autumn, and then come back up towards 1.75 again next spring. So what we've seen already is Murban price jump. So you saw Murban futures immediately jump well above the Dubai benchmark because it's now being set by the other grades in the basket. And that has kind of, I think, soothed some of the concerns about the Murban price.
I mean, we've seen that ADNOC are going to be running more Murban in the Ruwais refinery, substituting out some of that Upper Zakum before. So, we're going to see that tightness in medium sour probably probably alleviate a little bit.
You're also beginning to see fuel oil start to weaken slightly. The cracks in fuel oil have come off slightly, so there could be more
direct crude burn.
Exactly, and more loose medium sour as well if Upper Zakum begins to become a bit less value due to that fuel oil dynamic.
Definitely. But then there's also the question of OPEC, at least the voluntary cut unwind that we got last weekend. What's your thoughts on this? I mean, I think it's pretty clear from our side.
Yeah, I mean, as we've said in many of our reports, the 411,000 barrels per day isn't going to materialize on the market.
No.
So what this is doing is improving compliance. However, it does improve the optics and make the market look a bit like there's a bit more supply available. Perhaps there will be some more from the Saudis, for instance, but from the other members, it's unlikely to make any significant difference. So and you know, it's minimal impact, I think.
Yeah, and they're likely to increase production ahead of summer
naturally
burn season, because they're going to be burning crude for power generation. But realistically, this is going to be pretty immaterial in the grand scheme of things. We've seen, 7% of Canada's oil capacity come offline recently because of wildfires there. And that was about 350,000 barrels per day. And they're still disrupting supply there. So there's a lot of drivers at the moment. The OPEC unwind, for us at least, it seems immaterial.
At present,
there's varying analyst expectations about future cuts. There will naturally come a point, if you cut so far, you will come up to production. And
in terms of the quota compliance.
Exactly. And at that point, the Saudis could release more crude. The UAE have a little bit extra in the tank. But the
real story here of extra capacity is the Saudis, though, really, isn't it? They're the ones with the millions of barrels back in the tank that they could bring out. But
and the key indicator of their intention is the OSPs. And the fact that they're being a little bit less generous on the OSPs goes against the idea of a price war.
It's telling the market that they're not perhaps interested in that massive market share battle, the price war, etc.
They're not willing to really cut back prices to reclaim that market share. If we see them start to really underprice their OSPs relative to structure, that might then suggest that they're going to be turning on the taps, i.e. making more room for barrels. But we haven't yet seen that. So that's what we've been.
It's one to watch. But for now, not a major concern.
For sure.
Okay.
So to wrap up, do you want to just talk us through a quick summary of what we've discussed today?
So really the key thing has been the Dubai developments, the Murban pricing issues, and how people are thinking about perhaps rectifying or compensating for Murban setting the Dubai benchmark. The influence of that on the Saudi OSPs that have just come out, the upcoming ADNOC OSPs as well. And finally, what we think about the OPEC cuts and how, in fact, they're not as significant as perhaps some market commentators are suggesting. So with that, thank you for watching this episode, and make sure to stay tuned to Flux.live, our Twitter page, and Jorge's LinkedIn to see all of our reports. And remember to subscribe to the YouTube channel to get the next video.
Thank you.